And I am going to go ahead and just start us off as I typically do with these monthly updates with a prayer. And so let's go ahead and do that, and then we'll jump right into it. So, God, thank you so much for this group. Thank you that we're all able to be here together. Bless this conversation. Help us to know that our money is about a lot more than just building it. It's about the people we care about and using it to help others. And Lord, give us the wisdom and the discipline to do that. It's in your son's name I pray. Amen. All right. And so I need to leave this up for a second. Our compliance department told me. So I'm going to do that and let everybody read it while we're going through, and then we'll get on to today's agenda. But just a fair warning. All right, there's my disclosure for today. Doesn't mean I'm right, but we'll get to a possible one-day IPO here in a second that I'm going. But all right, so let's talk about the three components of today's conversation and today's webinar. And we always follow the same formula every month. And it's so important, you know, when you think about having a good foundation in your financial plan, it's so important to, I think, go back to your principles and remember how well-rounded we want it to be. And so in an opportunity to do that, we're going to talk about three different areas: investment planning. So what are we doing with your investments? Advanced planning. So what's an idea of how to help your financial situation beyond investments? And then relationship management, which can be something maybe behavioral finance, or a lot of what we do is the professional network. And today we're going to have Dee Smith, who is a insurance advisor, on to talk about that. And our advanced planning idea today is actually about umbrella policies. So I'm going to blend those two together. You know, if Dee was a tax accountant, I'd probably talk about the umbrellas myself. But since Dee is way more versed in the umbrella coverage than I am, we're going to kind of blend the planning and the relationship management piece after we get through the investment consulting. So that's really the main purpose of it. The next slide part here, this is really about what's happening in the markets, and this impacts, in my opinion, some of the changes y'all might have seen in your accounts over the last month. So early on this year, if you look at kind of what happened at the early part of this year, value stocks, small and mid-cap stocks, a lot of stocks that didn't necessarily do all that well during 2020 because they weren't necessarily the most suited for a COVID environment, they really rallied and did well. And you saw this rotation where in 2020, we made a lot of money on the value, or on the growth side of the S&P 500, and we really geared the portfolios towards that. In 2021, you started to see, okay, those stocks are getting a little bit more overvalued. Let's sell a little bit of that and invest over on the value side and some of the things that maybe didn't do as well in 2020, right? So this idea that, you know, you always want to sell what's expensive and buy what's less expensive. Well, year to date, up until about June, that worked very well. And then in June, it actually switched back. So June started operating a little bit more like what we had seen for the previous 12 months. And as you see, large cap growth really outperformed large cap value. So a few takeaways with that. One, that's why you're diversified and own both. But the second is, I think we're getting into a market where it's not, in my opinion, that hard to look out and see that 6 to 12 months, this S&P 500 is going to be a little bit higher than it is now. But I think it's going to be really hard to figure out where the leadership is to get us there and what parts of the market. And so one of the things we did is change the portfolio to be a little less sector oriented and a little bit more just total market and total diversification, because what you really want to see if you have high conviction is go after that conviction. If you don't, that's when you diversify. And we think this is a great time to get diversified. And we'll certainly keep you up to date if and when that changes. And then also the biggest concern, and I think part of why you saw growth rally back, is that this concern is starting to look less and less. One of the biggest concerns so far in 2021 has been inflation. And a few things have happened on the inflation front that I think are really pointing to transitory inflation and kind of what the Federal Reserve has said they expect. And that is, one, manufacturing is starting to catch up with orders. And so a lot of you guys know, as you tried to buy products over the past year, there's simply stuff you haven't been able to get, whether it's because they didn't deliver it, they couldn't build it, they didn't have the supply chains in stock, and you're starting to see that catch up. And that, to me, points to a more transitory inflationary environment. And the bond market, for example, you would see that reacting to it as well, which is that rates went up a little bit earlier this year, and they've started to come down, which also says the bond market is thinking this way about inflation. And then a good example also is when you look at where the prices have peaked, it really looks like that may have happened in kind of the May-June timeframe, which sets us up for really interest rates being able to remain low for a while, and that not be a bad thing, and that being a catalyst on the stock market. So I'll pause for any thoughts and questions on that, because the next thing I'm going to is about fixed income, which is a totally different animal. Okay. All right. So as we get into fixed income here, I just want to tell you all something we're looking at, and it's not something I'm advocating that we do yet. But when you look at fixed income, and that's typically your bonds and more conservative investments, one thing that really is apparent right now is that in a low interest rate environment, it is getting to a point where it is harder to make money in this part of the portfolio than it is during a normal time frame. And so a few things I think can happen there. One, you limit the amount of money you invest in fixed income to money that you literally plan to spend in the next 5 to 7 years, plus a little bit of contingent. And we're doing that goal not because we want to invest in fixed income, but because we want to spend the money at some point. You look for alternatives. Annuities, for example, are one thing that comes to mind. Sometimes I would say I like that for a piece of someone's net worth, sometimes not, but a lot of times that also limits flexibility. And so, what I'm saying today about fixed income may very much change in 3 years or 5 years. And so over the next 10 years, it may be that you get a great return there, but over the next 2, not as much. And then the other is you look at traditional investments that are an alternative to fixed income. And so if you look at this portfolio here, we're calling Core Fixed Plus. This is a way of approaching traditional fixed income, which would make up about 39% of this type of idea, and then putting in some alternatives to try to get a little bit more yield and a little bit more return out of it. And so that would be alternative income alternative, what we're talking. That's really just high dividend paying stocks. So you're changing the risk profile. And then these things called absolute return strategies. And absolute return strategies are often strategies that attempt to make a positive rate of return in any environment. However, they take away a lot of the market risk, and because of that, they can really be a drag sometimes on certain things, and also in really weird environments blow up. So I'm just saying all this to know that, when I come back here, on the stock side, we're feeling fairly optimistic over the next 6 to 12 months. On the fixed income side, it needs to have a role in the portfolio, but it's not a place that we're just screaming and excited about. And we are looking for some alternatives, but for right now, trying to find that conviction. So I will pause for any thoughts and questions on that, and then we'll jump into the planning ideas. Anybody? All right, so let's come on over to this personal umbrella policy, and I'm going to go ahead and introduce Dee on this, and we can come back to some of these slides as maybe needed, but instead of me rambling on this and then having her come in, we'll just go ahead and hit this one up together. So Dee, thank you so much for being here, and Dee has worked with myself very well, and also a number of our clients very well. She's an independent insurance advisor and runs an agency out of Roswell, and a great person to know and a great person to think about if you have any insurance needs or need a review. And one thing I like about Dee is, similar to us, she's an independent agent, so it's open architecture and can go to a lot of different carriers, not pinned into one particular carrier. So Dee, I'll turn it over to you. Any introductory things you'd like to say, and then we'll get into our conversation.
Well, David, thank you so much. First of all, before we start anything, thank you for having me here. Hello, everybody. My name is Dee Smith. I've been an independent insurance agent for about 26 years, give or take. If you guys are doing the math, I started when I was 4. Just kidding. Today, I'd like to talk to you.
Here, we use the language more than. We didn't say exactly how many.
Well, for those ones that like to do the math, yeah, I was an insurance prodigy at 4 years old. It's just been, a lifetime. And today I get to talk to you about one of my favorite types of coverage, which is a personal umbrella coverage. And if some of you know or have it, you know that this is a great financial tool to protect your current assets as well as your future assets. So a personal umbrella, what in essence it is excess liability. And the reason that it's called an umbrella is because it goes on top of the current liability limits that you usually have on your auto insurance or your homeowner's insurance or any other policy out there that has to do either with motorcycles or boats or something like that. So what in essence, it's an additional layer of protection. And one of the biggest things about insurance is that it gives you the ability to protect yourself against very large lawsuit settlements. It can be caused as a result of a serious accident. It could be a car. It could be somebody getting hurt in your property, even a worker that comes and does work on your house and they're supposed to have their own insurance or they're covered by their employer's workers' compensation. They can still sue you. They can sue you for any reasons for that matter. And what the policy does is not only protects against large settlements, but it also gives you coverage for costly legal defense. So that's why it's one of my favorite policies. Usually, depending on the type of situation that you have, the more assets that you have, that's how the policy is usually rated. But if you own, one house, 2 vehicles, the cost for $1 million of insurance coverage might be not even $200 a year. So you're actually, for maybe $14, $15 a month, you are protecting your bank accounts, your investment accounts, your house, the, legacy that you're going to leave for your family in the future. So for what you're getting in return for that $14 a month, I think is well worth it. I think everybody should have it. Even if you're not a millionaire, we all want to get there. And maybe with David's advice, we all get to be millionaires by the time we get retired. But you don't have to be one to be sued like one. So I always recommend that if you have, obviously when you're getting closer to the retired age, you don't have to worry about teenage drivers. But let's say that you own a pool and you like to throw parties. Great way to protect yourself is by having the umbrella coverage just in case somebody happens to get hurt. And again, you don't have to be negligent to be sued. So one of the beauties about the umbrella coverage is just having.
Frankly, what I find in general is for people on a call like this, a lot of people think just, I have a $1 million umbrella. That's necessary. That's already enough. And I'm going to go ahead and just turn that off so we can just have a conversation. And that might be more interesting than having to look at the slide. They'll think, it's $1 million. That's enough, and we had a conversation prior to this, and one of the things is, how do you recommend people decide how much coverage to get on the umbrella?
Well, first of all, they have to have a conversation with you and find out, what is the true amount of their assets. It's not only your physical assets like your home or properties, rental properties, but it also has, comes in consideration your financial investments, as well as you're still working, any future earnings. Once everything is add up, you want to make sure that your umbrella coverage pretty much goes above that limit. So for most people, $1 million is, it's enough. There is, occasions when, I have clients that have a lot of real estate investment. So I usually recommend to go higher than that when they're young, even if you're talking to a young professional that is not even close to retire and they don't own a home yet, but they're doing very well. They're executives, young executives, having $1 million of umbrella coverage start with, even if they don't have assets like a home, it's a good idea. It's a really good way to start a healthy financial future. So I would pretty much say start adding everything up and just select right on right for you based on what you have built over a lifetime.
Dee, one thing, and I don't know if there's anything you can do with this. This might just be one of those COVID 2019, 2021 moments, but your internet coverage is just a little choppy at times. So I don't know if it's like closer to a router or something, and if not, we'll live with it. We've all learned to do that over the last year and a half here, right?
I apologize about that. It's a signal thing, Comcast.
Yeah. So something she said about the future earnings, and that's a big one, because a lot of people here, either have good incomes or maybe you're retired, but you're thinking about giving this type of advice to your kids and grandkids. When I think of my assets, I kind of wanted one level, but when I think about my future earnings, I may want another level. And, think about that. Also, you mentioned, having a pool. Let's talk about a few situations where like you might have liability, yet you don't think you have liability. So like, for example, having a party at your house. What are some other ones that come to mind?
Having
and you were saying the party's not just what they do at your house, but possibly if somebody had alcohol, what they do on the way home.
Hey, David, I actually have
Go ahead.
So my front porch is like a concrete base, and it's actually sinking a little bit into the ground. So a little like lip between the steps is like getting big. And we had to like put a bunch of like wooding there and cover it up, because if like a mailman or someone slipped on that, I mean, they could easily sue us for negligence for not bringing the cement back up and getting it raised. So, yeah.
You guys, John Michael, just to introduce him.
That's a prime example.
Summer intern, and he's going into his second year of college at UGA. And so what we might want to do for this question, I mean, it's funny, Dee, when he popped in, I thought he was going to tell us something crazy that happens on college campuses. But we might want to play a game with John Michael, like what are some crazy things teenage kids can do to cause liability for their parents? Oh, I'm just joking. But yeah, Dee, back to that same question. Thank you, John Michael.
No, that was a perfect example. And, having a teenage, well, not a teenager, but, 19-year-old being at college and then being in a dorm and causing damage, that can impact the parents' liability. So if you have young drivers, if you have college-age students, it's a really good idea to have the umbrella, because you never know what they're going to do. Another great example is if you have a dog, they might have a biting history. They might never had bite anybody in the past before, but it comes, somebody to visit and dog gets scared and bites them. It could happen. I've seen it. I have had claims with clients where the dog that never bit before snap at somebody because they got too close to their face. So again, having a pool, having rental properties, loving to have parties hosting at home. If you have, a little bit of wine and they draw away after drinking at your house, you can be sued. Again, anybody can sue you for any reason at any time. So whether you're negligent or not, these things, you're thinking, oh, I don't have these assets. I don't know what's going to happen. The umbrella will make you sleep at night.
Absolutely. And so that's interesting with the dog. I swear my dog wants to kill the Amazon guy. I mean, it's so funny how much he barks at FedEx. And of course, now, back to the COVID world, we're getting packages dropped off all the time, and same thing with the negligence John Michael just pointed out there. Let's talk about carriers. So in general, if you have is it better to have it all with one carrier? I've known people, the one that comes to mind for me is Geico. Geico is great at car insurance, but it seems like when I've run Geico car, it looks good. When I run Geico home, it looks terrible. So the whole package might be better somewhere else. Talk to me about having it all with one carrier versus multiple carriers.
Typically, an insurance company wants to have access, to all your coverage. That is not because they want everything, they do, but they to avoid gaps in coverage. So typically the insurance company that writes your auto insurance is going to be the company that writes your umbrella coverage, because there is more exposure there. There's something more likely to happen while you're driving a car than if somebody gets hurt in your property. The likelihood of a car accident it's bigger. So if they're writing your auto, most likely they will be able to write your umbrella coverage. However, sometimes there is, occasions where the driver or somebody at the house might have a colorful driving record and there is more activity about that, what they can handle. There's companies out there that will sell the umbrella policy as a standalone. Same thing happens with high limits of, of liability coverage. Let's say that your assets have become, a good amount substantial, and you need, instead of the standard $1 million or $2 million, you might need $5 million or $10 million. And your insurance company may not be ready for it. That might be too much exposure. You can go out to market and find companies, reputable companies like AIG that will, that will write a standalone personal umbrella coverage based amount of limit that you want or the exposure. And again, at that point, you might not be paying $200 a year. You might be paying $400 a year, but I think still is worth it depending, on your specific situation.
God, that is such a small amount, and when you consider how catastrophic some of these.
I think the way that I see it, you can, pay $400 an hour to pay for your own attorney, or you can pay $400 a year for $2 million worth of liability coverage and legal access.
Yes. All right, so I'm going to try to whiteboard something here for us. Let me see if I can get my Zoom to let me do that. I just want to show something on insurance. You might like what I do here, you might not, but let me see here. Well, oh, there we go. It's a screen share. That's where whiteboard is. So I thought this was really cool. And I had a professor in grad school show this to me. So when you have insurance, and this is part of why it's so cheap and why it's such perfect insurance. So look at this. We kind of have 4 quadrants, and this is going to be, we'll say this is cost, right? And we'll say this is probability. So the P is for probability of something happening. If I was better at writing with a whiteboard here, I would spell those out. And so we kind of have 4 quadrants, right? We have things that are not very likely and not very expensive. We have things that are very likely but not very expensive. We have things that are very likely and expensive. And we have things that are not very likely and not very expensive, but very expensive. Does that make sense? And so what you really want to insure and you get the best price on is stuff that is expensive but not likely, right? Because out here, in this quadrant, the insurance company doesn't have to charge you much money, but you can get a lot of coverage, right? If you're down here, you just self-insure it. If you're out here, you don't need to insure it because it's cheap. You pay for that. So when I saw this, I thought it was really cool in the perspective of, pricing an umbrella compared to like car insurance. So like getting in a car accident is a lot more likely than like getting in a car accident and killing somebody, but it's also not quite as expensive as the other one. And that makes umbrellas work so well. So anyway, they also were talking about this, and I thought this was really cool when you put it in perspective of health insurance, which is there are certain things in health insurance that we're trying to use insurance on that are both very likely and inexpensive, and it's not very efficient. Whereas a umbrella policy, very efficient because it's unlikely and expensive. So there you go. That's my 2 cents on my insurance squares. Dee, any thoughts on that?
I think, again, some people are not crazy insurance, but if you insurance the way that it's supposed to be intended, which is a financial tool, it will let you sleep at night knowing that you can handle any potential downfalls, economic downfalls, as a result of an unexpected event. So I agree with you 100% on that.
All right, so let's question when you get all these policies. Let's say everybody has the right policy in order. About how often is it worth shopping around and testing one carrier versus another?
Well, I usually recommend that you shop your insurance every 3 to 4 years. Now, that doesn't mean that you can just receive your renewal and put it away. It's very important that you check out your renewal every time that you get it, every 6 months, every 12 months, depending on what type of term you have, to make sure that everything is accurate and the rate has not gone over wide. Insurance companies tend to file rates based on territory, zip codes, and losses. So if in certain zip code they have experienced a lot of losses, the rates are going to go up. Prime example, if you live in the metro area, there's more traffic, more likely to be in car accidents on a regular basis every day on 400. So the rates will go up. So once you receive your renewal, if everything looks okay, fair, because you don't want to make sure that you're in a fair premium. So if the insurance hasn't gone up substantially and your coverage is pretty good, it's okay to put away. But about 3 years later, after you did your your review, you want to make sure you take it out to market. Again, because insurance companies file rates. And, if they are profitable in certain zip codes, that's when you're going to see this, you're going to see the most savings. Another thing that is important to do is if you have had a life event, a life-changing event. That could be as simple as selling your house and buying a house in another county, in another territory. Perfect time to review your insurance because there might be somebody out there, another preferred insurance company that might have better rates. Something that insurance companies do is they come out with new programs, and it's very costly to them to move their policyholders to the next program. So what they do is they leave you grandfathered on the old one, and even if you have been their loyal customer for 20 years, you're not getting the best coverage or the best rates available in their newest program. So it's just a way to keep them on check. I would suggest calling your insurance agent. You are with a company that, has a captive agent like Allstate, State Farm, or Geico. They don't have a way to market your insurance and let you choose to see who has a better rate. So I would recommend calling an independent insurance agent, take it out to market with 15, 20 different companies and see what's the best way. If you have the right coverage and you're paying a fair price, it's a winning situation, or they can offer you something better.
Yeah.
Also, it's a win-win situation for you.
And to think about not just doing that only based on price. I know we had one client that Dee and I worked on together, and we decided to stay with their carrier because even though it was more expensive, there's this thing called lifetime insurability.
Absolutely.
Where once you've been with the carrier a certain amount of time, tell us about that, Dee.
Well, lifetime insurability is, a way for insurance companies to create loyalty. However, that used to be back in the good old days. They no longer have this coverage. So if you shop your insurance, when I'm talking to a new client, I like to review their coverage. And if I see that lifetime insurability endorsements, best recommendation is stay where you are, because what it means is that no matter what happens, if you have 27 accidents, they will not cancel your policy or they will not renew you. The only reason for that policy to cancel if you stop paying for it or request a cancellation. So those endorsements, companies nowadays are no longer offering that. When you review the coverage and you see it, it's for the best of the clients to stay where they are because they can pretty much do anything and their coverage will be guaranteed for as long as they own the policy.
So most companies now just don't offer that? I did not realize that.
Yeah, no, it's, that's an endorsement that they had in the past, back when I started in insurance. Remember the year, that I was telling you that I've been in insurance?
When you were 4?
When I was 4, back in the good old days, but it's no longer available in newer programs. You remember I was telling you that insurance companies come up with these new programs, new rates, new products. The new products most likely are not going to have the lifetime insurability.
Wow.
So if you have it on your policy, keep it. It's a good endorsement to have.
Very nice. Okay. Well, and this is a question I've asked almost everybody that comes on here, and then we'll just part for whatever, open-ended stuff that the group might want to ask you or you want to put out. But how, if at all, and it's not always that there is an answer, but how, if at all, do you see COVID changing your recommendations or, the insurance market?
Well, with COVID, it's very interesting because right at the beginning of it, we could see on, with my personal, individual clients where obviously they had more time to review their coverage, which that was great. Number 2, if COVID had impacted their income, they were looking for money, ways to save money. I don't recommend reducing coverage to save money, but I usually recommend, making sure to take it out to market. So you're still paying a fair price. So that was the biggest change, with individual clients. With my business clients, the biggest thing is employment practices liability. Because if they open and they made their employees go to work and their employees got sick, it would have an impact on their coverage because they could file a lawsuits against employers because they were contacting the virus while they were at work. So at some point, insurance companies kind of like put the brakes, and there was a moratorium on employment practices liability coverage, where if you had it, you could not increase it. If you didn't have it, those restrictions after the vaccine, there was a larger group of people, taking the vaccine, and the economy started opening up. Those restrictions from insurance company has still been moving out of the way, where now you can actually purchase the coverage again. So it has been pretty interesting on the way that it has affected every single aspect of the insurance industry. Workers' compensation, that will be a whole different type of discussion. But yeah, so many ways that it had an impact.
Wow. Well, I always tried to avoid catching COVID at work over the past year, but if I'd known I could sue my employer, I might have done differently there. No, I'm just teasing.
Well, I think they snuck out a law over there, so you can no longer sue. But yeah, that was a law that passed pretty quick, and you probably see it all over the signs when you go into establishments too.
Yeah, for you guys working in corporate America, no wonder they wouldn't let you in the office. But all right, well, with that, Dee, anything we haven't covered today that you think we should, or that you'd like to make sure the group knows?
You guys have any questions that I might be able to answer for you? Anybody? No.
All right.
In that case,
and I can do.
My recommendation will be review your coverage.
Yeah. And if y'all are working with us, you can either go to somebody like Dee directly, or if you give us your coverage, we'll go to Dee for you and make it zero work on your part. And then also any investment questions, open for things there or anything else. Just the only thing I won't answer is what does future tax policy look like? Because right now we don't know. All right. All right. Well, we will give you guys a time bonus today and go ahead and wrap up. So I know everybody hates finding 20 minutes in their day, right? So everybody be safe. For those of you that this is a big transition for over the next month, good luck getting people back to school if y'all have students in your house and all the things that go on with that, and the nice structure that comes back to our lives and our schedule when we have a school year going on. And with that, thank you guys for your time, and feel free to reach out to either of us if you need anything individually. Thanks, guys.
Thank you, David.
Thank you very much.